everybody to breakout number 2, access to capital and assessing debt versus equity trade-offs. I'm just going to turn the time over to John Adams, who's going to be moderating our panel today. He is a managing partner at Cook Martin Poulson. So, John.
Well, thanks for being here. Thank you for taking the time on a rainy day in Cache Valley, Utah. It's good to be with you, and thank these 4 gentlemen for taking the time to kind of guide us through a question that many of our clients at our firm have quite often for us. How do we get capital? There's different ways and different kinds. So we're going to first let them introduce themselves. I'll start with George and work your way down to Terry, and we'll go from there.
I'm George Daines. I'm the CEO of Cach Valley Bank. My training is in law. I graduated from Utah State with an economics degree. Most of my time in economics was spent in economic history, writing with Leonard Arrington. I went off to Yale Law School after I finished my time at Utah State. I went from there to Salt Lake, thought I was going to a large law firm, and in a spectacular act of bad judgment, decided to come back to Logan and practice law. And I've been involved on and off with Utah State over the last 30 years, teaching a class here and there. And I've also been involved with a small bank that has become a very large bank at this point. Talk a little bit more about that pathway, but I'm happy to be here and talk to you today.
My name is Roger McOmber, and I'm currently involved in mostly startups, and I actually graduated with an MBA from here at Utah State back in '90, and spent most of my career in New York City. Worked for a number of different firms in Wall Street as an equity analyst, and had the opportunity to work at Salomon Brothers in the early '90s, and got to work for Warren Buffett when he came in and saved Salomon Brothers after the equity scandal that should be a case study actually here, and worked there for 13 years, and I currently live in Dallas, and I was running my own energy hedge fund until 2007, and Lehman Brothers was one of my prime brokers, and so that's a bigger story that we can get into, but so we shut down the energy hedge fund at that point, and I've been doing private equity since then, so it's good to be with you.
Thanks. I'm Ed McNulty. I'm one of the managing partners at CVF Capital Partners. We manage Central Valley funds, and I guess in way of background, so I am a recovering New Yorker as well. Went to undergrad and graduate school in New York. Out of there, went into banking and thought I was going to be an international banker. And 2 things happened. One, I met a girl, and second, at the time I went into banking, the bank, had issues in terms of coming out of the '70s with a long recession. They had $4 or $5 billion worth of criticized assets which needed to get fixed. So I unceremoniously got dropped into this group and said, try to clean up this mess. And 5 years later, we figured out how to do that because we had at that point no career risk. We were just all brand new. And that group turned into a leveraged buyout group at what's now JP Morgan Chase. So we were part of a group that sort of did lots of leverage on Wall Street through the '80s. That turned into a merchant banking group, which started investing in small to middle market companies. And so that turned into investment banking. And in the 2000s, I left Chase, started a private equity fund in New York City, did that for a couple of years, and my wife, who's a California girl, eventually dragged me out to the West Coast, and so now I've been doing it with my partners for about the last 13 to 15 years.
Great. Good morning, or maybe it's afternoon now. Terry Grant is my name, and I oversee the operations for KeyBank here in the state of Utah. We have 26 markets from Maine to Alaska, headquartered in Cleveland, Ohio, and I am fortunate enough to to be here with some amazing people, two of which are here to support me today, and glad to have them with us. My personal story is, in fact, it was just not too long ago that I was, and some of you might have been there, here on campus in the Perry Room, and we had a panel discussion on careers in banking. And as I said then, I don't know anybody who grew up wanting to be a banker. We all have kind of fallen into it somehow, but I've enjoyed 30 plus years in the industry. Started my banking career in Denver, went off to graduate school and was hired by a Canadian bank after that, where I banked in LA, and then they took me up to Toronto, Canada, and down to New York City, where I joined a large French global bank there, and oversaw I oversaw about a little over $2 billion in credit exposure, and I oversaw the group that managed Lehman Brothers and Bear Stearns, and now luckily after 9/11, my wife and I are both native Utahns, and we decided to move back to Utah. So I was not there when everything started to implode. But one of my very good friends, Ace Greenberg, wrote an incredible book, An Insight, about the demise of Bear Stearns and what happened there. And anyway, so been back in Utah for a little over 15 years. Been with a couple banks in town, and just love being with KeyBank right now.
Thank you, guys. As you can see, we have quite a panel and a wide range of perspectives. And so that's where I wanted to start with, is not only that, but the topic of capital is also wide-ranging. So from each of your perspectives, kind of get us, from I'm going to start the early stages through the growth stage. Let's not go to the enterprise stage, but let's stay there for now, and then maybe there's some questions later. But George, we'll start with you and come back this way as well. Again, we put the banks on the end unintentionally. I just realized that. But from your perspectives, what are those opportunities that a company looking for that extra dollar to make that grow?
Do you want to start with early stage?
Yeah, I mean, Roger, you want to start first? That's really where you're at.
Yeah, well, I mean, I'll take one step back on that just a little bit. I mean, Warren Buffett always said, he goes, if you want to start a successful business, find something that nobody wants to do, and then do it better than everybody else. And if you look at his investments, that's really kind of what he has done. And it works very well, because it's natural to want to go after the shiny objects. It's natural to want to go after the sexy businesses. But those aren't always the most successful businesses. So find something that nobody wants to do, and then do it better than everybody else and become the standard. He also said, I don't invest in stocks, I invest in companies. And I look at that the same way when I put capital into a company, is I look for companies that do that. I look for that. Now he says, when I invest in a company, I invest in the people. It's the people, the people, the people, to quote Warren Buffett. And that's what I look at as well when I'm putting investments into a startup. So how am I different than the rest of the on the panel? I'm early in the life cycle. Okay, so the way to look at the life cycle is really on a risk tolerance spectrum. So I'm willing to take on a lot of risk, but I expect a lot of return. So I'm the most expensive capital on the panel, because I require equity, I require ownership, all right? And that's the most expensive. And so I'm going to be looking at your opportunity, I'm going to be looking at what's the probability, and I'm also going to be aware that only about 1 out of 10 of the startups that I like even are going to succeed. Don't shoot the messenger, it's just the facts, that's just the reality. It's hard, as we heard this morning, it's hard it's hard work to do a startup. But yeah, the capital that I'll put in will cost you ownership, and you have to say, is it worth that? And I'll finish with the one thing that when I work with companies, I work with them. When I invest in a company, I work with them. And I also require of myself, I require the same of other money that comes in, and it's a term I call smart money. We don't just want money, we don't just want capital, we want smart money. And that means we need, with your money that you're bringing in, you need to bring in relationships, you need to bring in skills, you need to add value to this company and help it succeed.
So we sort of come along next in the spectrum, and if Roger is expecting 1 or 2 of his companies out of 10 to make it, we're sort of better than 9 out of 10, because we are, for the most part, sort of either lenders of subordinated debt and taking a bigger risk position behind the bank, or we're equity investors. And it sort of depends on the company, it depends on the circumstance. But by the time someone gets to us, they have a developed product, they have a developed service, some good amount of revenue, preferably a couple million of EBITDA, but they could be just coming up in EBITDA if we go a little bit earlier in our investment spectrum. But we're looking for people, we're looking for a durable idea, service, or something that we can sort of lean into, and either will be more equity-centric or debt-centric, depending really on the 5-year business plan. So we look for the company macroeconomic factors that are going to impact it over the short to medium term. We look at the company's business plan and sort of see where they want to take the company. We make an assessment as to whether or not that's feasible, and then from our point of view, what capital resources are required to support that? Is it debt? Is it equity? Is it some mix? And how does that all come together? And as we're looking at all of this, one of the key assessments we're making, back to Roger's point, is the people, because we as subordinated lenders, we as equity investors, are not going to have the luxury of asset coverage or a second way out if the business doesn't do well, if the management team doesn't execute. So we are very focused on the individuals and the management, whether or not they can execute, because we're really betting on them.
I'll go Terry and then George. From the banking perspective.
Okay, well, we are, the banks are where you want to get to, just to be honest. That's your goal. That's the cheapest cost of funding out there. It doesn't require any equity. We lend against you. Some of the same criteria, though, used from what was just described, is the same criteria as banks we look at. My first and foremost, when you hear about, am I a bankable? What does that term mean, bankable? Am I a bankable company? Well, every one of you, I hope, when you start a company, you go in and you keep your funds, personal funds, separate from your business funds, and you go into a bank and you open a bank checking account and maybe get a bank credit card. Do just nothing but that. I mean, so there's things that banks can do for you right up front. And help you with some cash management needs possibly. But as you move along the spectrum, you need that capital, and I think that's really what this panel is about, is how do you get that capital, which to George and I will be debt. and how do we look at that risk versus return from a bank point of view. So first and foremost, I'd just say, just go back to that term bankable, and then I'll let George kind of. But for me, and maybe our definitions, and each bank might be just slightly different, but for me, in my experience, first and foremost, it's the individual, just like what was mentioned. And then the product and industry that they're in. Does that make sense? I can tell you, if you're in I think I'm saying this right, cannabis oil industry, we're not going to bank you. That's just something that federal banks can't do, is bank people that are growing and selling weed, even though it might be legal in some states. Still nationally, it's not federally, so we can't touch that right now. But there's other industries too, and I shouldn't just pick on that. There's other industries that are legal, federally legal, that sometimes companies have a tougher time getting debt within those industries. And then we start looking, do you have a track record of profitability? And start looking backwards. And then we start looking forwards with you. Do you have some assumptions that you build into some pro formas that you want to look at, and how you want to move forward with the company and where you think you're going to be? And then we're seeing if you're going to be able to service your debt. Cash flow is still king. Neither one of us want to take back any assets. That's not who banks are. We don't want to foreclose and take an asset and try to figure out what to do with it. So really, cash flow is king. We want to make sure that you have the cash to meet your fixed costs, your operating costs, your taxes, your lease or mortgage, all those kind of things, and then you have some excess cash there if things come up, and then cash to service our debt that we put on the books with you. Probably some of you would want to consider very close in your banking stage the SBA product. And I'll just leave it at that. I won't go into that too much, but they can do things in the SBA product because of some uniqueness there with the government backing it that a traditional, more conventional loan we cannot do, that helps us as banks get there. We team up with the SBA to make sure that happens. George.
I'm going to give a little more background to what Terry said, and Roger and I are on the opposite ends of the pole. And I think if you understand a little bit the matrix of what drives commercial banking, you'll understand it. Our cost of funds ranges from 0.5% to 1% right now. That is, the money that we bring into the bank, we are obligated to pay for that money. We have to make the payment irrespective of whether our investments pan out or not. So we're not using equity money. Principally, we're using deposits. Those deposits are insured by the FDIC, which gives them license to regulate what we do because they don't want us landing on their insurance fund. So our cost of money is 0.5% to 1%. Our cost of operating a commercial bank, there's a range again, 2.5% to 3%. That's what it costs for the brick and the mortar, which is actually a small part of our cost. Most of our cost is personnel right now. But you add the cost of funds and you add the cost of operating, you're at 3.5% to 4%. We lend money at 5%, 5 or 6%. Our margin is 1%. If you're a good bank, you make 1% return on your assets. If you're a really good bank, you can make 1.5 or 1.75% return on your asset. That is a very, very small margin. So when we make a loan to someone at 5.5 or 6%, we're hoping we're going to make 1 or 1.5% on that. If you figure a failure rate into that, you can't handle very many failures. So when somebody comes to me and says, hey, I got a great idea, I'm sure it'll work. Well, I'm 95% sure it will be successful. So, okay, well, let's see, 5% failure rate, my margin is 1%. If I have one of those fail, how many good pizza restaurants will I have to make up the one that doesn't work? So the result of that matrix in a commercial bank is to drive us toward reducing risk. And that's the opposite of what Roger does. Roger is looking at taking a risk. His cost of funds, there is a cost to him, but it's entrepreneurial. He doesn't have the FDIC regulatory system. Nobody insures his money, and his system is designed to allow a fair amount of failure. But if you have a fair amount of failure, you got to hit some home runs and some triples. We're looking for a consistent run of single, and we do have home runs, but we don't make the home run. If you bank with us and you're paying 5 or 6% for your money, and you hit a home run, it's all yours. because we don't have any of your equity. In Roger's case, he gets a piece of it. This is a capitalistic system of engineering risk reward around a range of alternatives that allows access to capital. So when you come to us and you have a great startup idea, you're going to find a very careful parsing of, okay, that'll be great if it works, but what happens if it doesn't? Do we get your home as collateral? Do we have your father's? Do you have a car? I mean, all these questions that seem to evince we don't have faith in your great idea get asked. And so commercial banking has those limitations. The bank I'm working with is a community bank. The bank that Terry's with is what we would call a large regional bank. So we're more involved with local people in the sense of being a relationship banker and in small businesses. We have roughly, I don't know, what would it be? Roy, $800, $900 billion worth of loans out there. Our loan turnover about every 3 or 4 years. Our interest rates are ranging between about, what, Clint, 4.5 to 5.5, 5.5 to 6. So that's the range in which we operate. Anyway, that's the background.
That's a really good perspective.
Mm-hmm. In any given capital structure, all three of us can reside happily in the same company, in the same capital structure.
We have several deals that we have exactly what was talked about here about with subordinated debt and other different structures that we team up with private equity and finance private equity's acquisitions for the senior portion. So yeah, we do a lot of that kind of stuff.
The mistake comes when the bank thinks it can deal in Roger's space, or Roger pretends he can deal in our space, because we're an apple and an orange, and we need to understand what the benefits of our role are and what the risks are. And we understand Roger's business and we support it. It makes all kinds of sense. So anyway, that's
So there's a question asked in the earlier panel by I'm assuming it was an enterprise owner. When is it time to get capital? I'm not going to ask that question. I'm going to more specifically ask what happens when they come in to sit in my office. How do I find the right partner? What does that right partner look like? Roger, what, from your perspective, if I am that enterprise looking for you or Ed, what does that partner need to look like from my perspective? Who should I be looking to partner with? Because I look at it as a partnership.
Right. Well, I think it goes back to what I said about smart money. Okay, and what I mean by smart money is that make sure that the money coming in is bringing more than just money, it's adding value. So again, expertise or relationships, it has to be smart money to come in to make it work. And the reason it's a rule for me too is I think there's a difference between venture capital and vulture capital. Okay, and maybe that's another meeting, but we can talk about. But vulture capital is coming in, structuring it in a way where sometimes they structure in failure. And they know that if they do so much debt versus equity, they can make it sound good, and then they will own the company pretty soon. I know people that do that. I don't think that's the best way to do it. I think you want to come in as like you said, as a partnership. That's where I've had the most success, is in being able to help a management team and give my experience to them and say, here's what I've seen work in the past. You might want to try this. Here's some other people that we can do. So bringing in those relationships is key, and expertise and insights with your money is key.
Mm-hmm. But there's a spectrum here too in terms of partnership with management. In the early stage, you're going to be working very closely with these companies because they need everything. They need all sorts of resources because they're just getting going. By the time they've gotten to us, a lot of the fundamentals have been developed. But we're still going to be risk capital, whether we're subordinated debt or whether we're equity. We're going to be sitting on boards, and we go into a company with a plan to not just provide capital, but to really work, hopefully on tasks specific to growing the business or to de-risking the company or removing obstacles to growth. So the working relationship really is very close. We're not just providing a check and saying, just send us your quarterly statements, let us know how it all turns out in 5 years. We're talking to management teams, sometimes daily, sometimes weekly, or sometimes if it's quiet, it can be a couple of weeks. But we're interacting a lot. So when you take capital from people like Roger and I mean, you are forming a relationship. You're forming a 5-year, or longer partnership to really build a business, shared around a common vision and common objective. And even though we're not typically at CVF what you call majority investors, where we own the majority of the common stock, we act as if, in partnership with management, it's as if we have the exact same ideas and we're pulling the same direction, regardless of really who sort of calls the shots and the votes.
Terry, George, from your perspective, clearly it's different, but how do you bring that partnership in when somebody signs their house away?
We have had an interesting experience through the recession. We have a commercial bank when the world kind of turned upside down in 2007, 2008, 2009. A large number of banks failed, and you also had a lot of business failures that were embedded in the banks that failed. The FDIC repossessed those businesses, those banks, and they were looking for a partner to cowboy their way through those assets. And this little bank in Cache Valley decided that we would turn into you for a while, Roger, and you, Ed, and go out and take those assets in the division of the company and manage those assets for the equity we could get out of them, and our partner was the FDIC. So we turned into a different entity there. And we actually set up a branch, we called it Branch 49, and we hired different personalities to operate that. And we had a lot of fun with that, and it ends. And now we're trying to integrate those people back into the bank. And it's a little bit, so it's a little different, but the idea of a solid relationship with our client is what makes our bank profitable. So we're very interested in having officers who can form quality relationships and add value, because money is fungible. The dollars at X percent, the difference between KeyBank and us is really the front end officer who's managing that loan with the customer. That's the way we distinguish ourselves, one bank from another. That's why you would bank with us as opposed to someone else. It's the quality of the officer and the quality of the relationship that's really where the bank meets the client. We're a commercial bank. We're not a consumer bank. We don't really compete with the credit union. So we're very interested in that relationship. We want to form the kind of a relationship that will last. If a person comes into the bank and is interested in a one-off deal, we're probably not interested in them. We're more interested in a long-term relationship. I don't know whether that really got to where you wanted it to go.
I don't think I had anywhere I wanted to go other than
more
different
information than you
perspectives.
wanted, right?
Different perspectives.
Yeah, let me just add to that. We have some incredible banks in the state, from the small local one-branch community bank up into the 5 large banks here in town. Well, I should say in the state. Each one brings a unique perspective and a culture. I could not agree more that those frontline individuals, so KeyBank being a full-service bank, I've got with me, we have our retail branch manager, we have a business banker, we have our treasury management officer with me today. So we bring a full slate from private banking to helping the business owner, help if they're looking to sell their company and have that liquidity event in their lives. You can bring a lot of things different. But I came from Wells Fargo right before I came over to KeyBank. Very different bank, very different way of looking at clients than what we have at KeyBank. A JP Morgan Chase, very different than the way that Cache Valley would look at a client and what kind of a relationship they want. So each bank, you need to kind of shop around and find out what do you want out of a banking relationship. Because you're right, money is money, but really it's how is that delivered. And for us, it's all about client centricity. And if we take care of our communities that we bank in, take care of our people really well so that there's not a revolving door, and making sure that they are engaged, and then we take more care than anybody else in our view of our clients, then if we hit those three things, then I think we're doing all right.
Perfect, thanks. I'm going to open up for questions since we have about 15 minutes to the audience. Questions?
And my question's for Roger. I'm curious if the approach has evolved over time. You talked about you want smart money. It seemed like years ago it was, hey, we'll put money in and you just make it better, right? You just need the money go. Has that evolved over time, or is that just something that you learned early and you've used it?
It has evolved over time, and I think for me, it's evolved and it's come to that. I think you'll see it in the marketplace evolve too with the market. Okay, when the market's good and everyone feels like they're a genius because they don't realize that everybody picked the right stocks and they think, then in that environment, money is pretty easy because there's a lot of money out there and it's flying around and it gets reckless. And I think Warren Buffett also said that he loves recessions. And John Huntsman also said that too. I love recessions, which always comes off a little scary, but the reason is because that's when you find great opportunities. But that's the hard time to find capital too. That's the hard time to. But be aware of your environment. Is market up, is market down, and that will impact how capital comes in. Mark Twain once said, it ain't what you don't know that will hurt you. It's what you know for sure that just ain't so. And I think that's an important thing to keep in mind as you're doing your own due diligence, as you're doing your own analysis on these and trying to figure out the capital. And it's a good concept.
So my question is for the bankers, other than the early money or the equity money where you've got people or a network of understanding or evaluating the opportunity, bankers, how, yes, it's late money, other than historical EBITDA, how do you have the depth to understand the opportunity that's being pursued for that organization?
Go ahead, George. I'll follow you.
Let me make sure I understand your question. How do we evaluate someone who is making a request for a loan?
Other than the historical history that they have. So I've got a new idea which is outside of our current business, or I want to build another building, an expansion, and I have logic for the expansion. So I'm trying to understand. And you go to the early money, they've got all kinds of resources that they can reach out to understand new ideas, new products, new products.
Okay, that is the meat and potatoes of what we do every week. Let me explain the process and then add some content to the process. You're going to meet with a loan officer. He's going to try and understand the idea. If he knows you well, he'll know what your track record is. If he doesn't know you well, he'll want to get some history about you. Are your good ideas pan out over time, or are you one of those people that has lots of ideas and no performance? So he's going to want to learn about you, learn about your history, and if he thinks it's a good idea and it makes sense to him, he's going to write it up. We try and invest him with the tools to make an evaluation. He'll interact with his loan team about that. Other people that maybe have experience in your new idea area. Then the next step is it comes to a loan committee. A loan committee in our bank is 10 or 15 people. The loan officer's sitting there. We're discussing the whole idea. Does this make sense? There could be a preliminary approval, followed by appraisals and more evaluation, followed by a final approval. We hope we're sifting out the ones that meet what you need and the ones that will fit into our model. Because if it's more a Roger model, it's probably something that we say, you know, the risk here don't work into our model. You ought to look for a partner who has money or an equity investor, something like that. So that's some of the things that are interesting that I've learned over time about evaluating people, and sometimes the people who are most difficult to evaluate and who are sometimes become the best borrowers. Also, people who have had a problem, that doesn't rule them out as a good borrower. It's more how they dealt with the problem than whether they had a problem. In fact, I would tell you that some of our best customers are those that had difficulties. But when you watch someone work through a difficulty, you learn a lot about their resiliency, their ingenuity, and their ability to work. So a person that comes in and says, you know, I had this problem 2 years ago, am I bankable? Well, we look at how they resolved the problem more than the fact that they had a problem. The person who's never had a problem, who's never had to go through working out some failure, is not a real good candidate because things do go bad. So is that an answer to your question?
Yes, historically good.
Let me just add you know, I don't know if that's a fair characterization that bankers don't have that background to be able to help make those assessments. You know, our frontline people are out there day in and day out. They're seeing all the spectrum of different ideas coming at them from different industries. And then we have national resources we can pull on too, from analysts and others to think of where this industry we feel is going. And if you have a business and you gave the example maybe doing something that maybe isn't right primarily associated with your current business, getting to George's point, you know, what resources do you have to support that? What we want to make sure your skin's in the game as much as our skin is in the game, right? So will you sign an unconditional guarantee that will bring the resources that you have with the resources we have, and we can partnership up together? So I feel we do, and you're right, banks can't be everything to everyone, and we don't even pretend to be, but what we can do, we do very well, I think, as an industry.
Sort of a two-part for Roger. Part one is how do you find people like you so that you can pitch your ideas? And the second question is when you listen to the pitch, what is it you're looking for that helps you determine whether this is something you'd be interested in?
So those are good questions. You know, it's hard, and I feel for the CEOs out there who are focused and should be focused on what they do well. And what they do well is their passion, it's their business, it's their company. And the amount of time that takes out of a CEO or an entrepreneur's schedule to actually go out and find money and find the right partner is tough. It really is. There's no easy answer to that. I think that it gets back to relationships. I mean, and you can find. I think I'll just give an example to try to address those questions quickly. We had a little startup. It was up in Seattle. It was called Eagle View, and we had this little idea. It was started by a roofer, and it was measuring roofs with pictures. So we had an algorithm that would sew pictures together from aerial pictures, and we could measure roofs from the air rather than sending Joe Bob over with his F-150 truck and throwing a baseball with a rope attached to it and thumbnail. That's how most roofs were measured, and so we came up with this technology. The roofer did actually, and so we perfected it and brought it out. I thought, and I was friends with the CEO, and he called me, and he goes, "Hey, you want to meet me in Seattle? And I've got this cool little company." So I went up there and I said, "This is a cool little concept, and I know you. I trust management. Let's go to New York City." And I thought, this is going to be a slam dunk. This is because I'd have all these relationships in New York City. Spent a couple days here. We visited. We had 2 days of meetings. Guess how much money I helped him raise after those 2 meetings? Zero. Okay, zero. It was too early. Where's your historical EBITDA? Where's your, all the usual things that you get. And so what did we do? We said, well, we've got a few customers that are excited about the product. So we went back to the customers at that point and we said, hey, this is a cool concept, you like it. How much do you like it? We're looking for some good partners here. And I won't go through all of it, but we found one who said, I really like it. And I like it enough that I'm going to put in this much money. It was enough money to really get to the next level. Matter of fact, it was the last money that we took. So 2 years go by, we're doing pretty well. All those meetings I had in New York City are now mad at me. Why? Because I didn't get them involved. Because it went from just that money that came in with the partner of the customer, we were now 10x from where we were. So hopefully that's helpful.
Can I add one thing? Over the years, I've been a board member of some great organizations here in this state. So to identify what I think you're asking for, we have Association of Corporate Growth, ACG Utah, that has a Capital Connection conference here once a year. You see a lot of private equity firms there. You can go around, talk to them, build relationships, understand where their niches are, what their interests are, where they invest, where they can add value. Mountain West Capital Network is another organization that we have in this state that's incredible. They bring in speakers and help you make those capital connections. And then we have some amazing incubators in this state too, that really help the entrepreneur. You can set up a desk inside an incubator. They have relationships and connections out there. So there's a lot of resources, but it comes down to people and networking and getting into those organizations that really can help propel.
Thank you. We only have a minute left. I'm going to ask one last question, and I'm going to have you answer it in 1 minute. I know you can't, but I'm going to ask how you do it.
Great, thanks.
One of the things that has come up much more as of recent is social impact investing. Mm-hmm. Just very broad, give that landscape for us. What you're looking at, in that, because I know that is something, especially for you guys out here.
Well, so this is something that's been evolving really over decades. It started in the 70s and 80s with pollution, and let's not poison the rivers, let's not poison the air, and it's sort of become more sophisticated over time. And now, a lot of our investors in our funds are looking for an ESG type of policy, which is environmental, social, and governance. When you invest in a company, you're just looking at the numbers, or you're looking at how the company really comports itself as a citizen. And you know, we find actually the companies that have thoughtful policies, you know, along these lines are also good investments. And it's not saying that just because it's feel good, it's because they have really a consistent discipline and a methodology about looking about how they, you know, work with the environments that they touch, you know, not only just, you know, the physical environment, but their suppliers, their workers, their investors. And to do that requires a discipline and a consistency over time. And if they do that, you know, along the, you know, sort of the social investing lines, you know, they're probably also pretty thoughtful about how they run the business. So, you know, we do sort of try to marry the two. And, you know, the trick for us is really sort of doing it visibly and consistently so we can sort of, you know, find the metrics and demonstrate progress against those. Perfect.
Thank you. Thank you, each of you, for your time, for your expertise, and for sharing a few thoughts. I know that the topic is very broad. Didn't touch on, we scratched the surface at that. But that's the purpose of this forum, is to mingle and to get to know one another and to network. And so thank you for your time as well.